Hello everyone, welcome to RJ Sanderson TV. We're in 2026 and we can't wait to give you all the updates on finance, tax and the economy. Roy Sanderson alongside me. Roy, we're in year 7, can you believe it?
Year 7, Dave, this is wonderful.
We've started high school. This show just continues to go on and we've got another big show for our viewers today. Roy, we'll touch on the budget. We've got some tax tips and also those viewer questions that have been sent in over the off-season. Speaking of the off-season though, Roy, we want to keep ourselves accountable on this show. Let's have a look back at some of our predictions that we made. How did we go on our predictions front?
Well, I predicted interest rates to be stable for 2026 and that's not what has happened so far. I said it's going to be a great year for the share market. So far, it's a little bit ordinary, but we've got a few months, 6 months to go, so let's wait and see. Property prices to be flat or decline. Certainly that's happened in Melbourne, and we will see some slides on that soon. Inflation rates to be steady. Might have got that wrong because inflation has jumped up, and rents to skyrocket, which they continue to increase surprisingly. But you nailed something, Dave.
Well, I mean, let's have a listen. Well, yeah, we have to have a listen, don't we? I think, Roy, I'm going to put a prediction on the show here. I don't think there'll be a rate cut in 2026. I think that number is actually, the CPI number is quite concerning, along with higher unemployment, and then also along with that consumer confidence number. If people are out there spending, particularly if it's a big Christmas spend, I don't think there'll be a rate cut in 2026. Yeah, look, it's not something that you want to be too happy about, rate increases, because there's a lot of pain out there. But I think the point is that inflation was out of control at the end of last year. I think the point that I got wrong on that was that it would be consumer spending driving that. I don't think it's that. I think it's government spending. And I think that it's a really concerning trend. And we're going to talk to inflation a little bit later in the show. But yeah. It doesn't look like it's going to be a year of steady interest rates even from here on. It looks like there could be another rate increase.
Could be, but interesting, when you made that prediction, Dave, I think you're the only one out there who said that at the time. So, nailed it.
Thank you, Roy. Done. Let's hope we can make some good predictions on the shows to follow this year. And let's also make sure that we can deliver some tax tips to the viewers. And let's kick off, Roy, with EVs. A lot of people have turned to EVs at the moment with surging oil prices, and there's some tax incentives still available for people out there. Yes,
although we will talk about the budget shortly, the budget has extended these EV benefits. We know that there's 2 forms to claim your vehicle, either the 5,000 kilometre method or the percentage based on your logbook that must go for a continuous 12 weeks. The rates are 4.2 cents per kilometre for charging at home, and this is a common question we get. I've got an EV, how do I claim the cost for charging at home? You do it on a per kilometre basis, and that changes to 5.47 cents from the 1st of April 2026.
RJSanderson.com.au to get your free logbook. And speaking of which, RJSanderson.com.au to make sure that you book in your tax return for 2025 financial year, because that deadline's coming up.
Yes, just a reminder to everybody that 15th of May is the deadline. We can apply for an extension if you need it, but work on getting the information to your accountant before that date if possible.
Speaking of having the relevant information, the ATO is always auditing people and businesses, Roy, but they've got some particular targets at the moment.
Yes, thought I'd list these out because the ATO go public on what their targets are. Investment properties and holiday homes. If you have a rental property, they're looking at repairs and cryptocurrency gains. The tax office already know that you've got cryptocurrency. They know if you've got a gain. They don't know the amount because all the information about crypto from the platforms is supplied to the tax office. So if you choose just to ignore your cryptocurrency gains, you will get caught.
There you go. That'll just get cross-checked. And I think this is an interesting one, Roy, because a lot of people, when they think tax, they think, oh yeah, I'll get onto it in September or October, November, but actually the benefit of looking into that before the June 30 end of financial year can be enormous.
It can be, and this is not just about RJS, this is about every taxpayer out there, from individuals to businesses to self-managed super funds. You should reach out to your accountant now, before June 30, and just ask a simple question. What can I do to save some tax? And every accounting firm will have some things or comments that they will help you with to save some tax. Reach out. You should.
And if you're a truck driver, you should reach out as well, Roy.
Oh, this is huge. Finally, a court case that has gone in the way of the taxpayer. The rule has always been truck drivers could claim meals, as per the list there, up to $165 for a day, including out of pockets. But if they got audited, the truck driver actually had to show receipts, despite the fact that there was a ruling that said they didn't need to substantiate it. Unfortunately, auditors have a different set of rules. Well, Shaw took this to court. It went back and forward a bit, but it finally got decided that the taxpayers can rely on the no substantiation required as long as they can prove the nights that they were away interstate using their logbooks. So huge win, and you can go back up to 2 years and amend tax returns if you didn't claim the set rate. So that's also a plus for truck drivers or anybody who stays overnight.
And $66 for dinner, you can get yourself a nice Scotch fillet there. I think that works.
And you don't need a receipt for it.
Very good. Okay, well, make sure you get yourself a steak dinner. If you're on the road now, you can claim that one. I think another one that we need to mention from a legal perspective is this one, Roy.
Yes, so we often get asked about what the powers are at the tax office. Here's an example where the ATO seized assets from a person living in Australia but had income overseas. He was a Chinese national. It hadn't been declared in Australia. The tax office discovered the income and they then assessed him. And the tax on that income over a number of years was $27 million, huge. And he had almost no income in Australia, but he owned 5 properties and had various prestige vehicles. So the ATO, they took action and they seized a property in Collins Street to try and clear the $27 million worth of debt. So keep that in mind.
Well, Roy, last night, Tuesday night, was the federal budget delivered by the Treasurer, Dr. Jim Chalmers, and he called it a budget that was a platform for tax reform, and there is a lot to unpack from this. Roy, you've got a few of the highlights that you've listed out. There's a lot to consume here. What were some of the things that took your eye? Yeah,
these are the major ones. If you're working, you get a $250 tax offset, which is like an extra refund, but it won't affect you until the 2028 tax return. Existing property investors are not affected by any of the negative gearing or capital gains tax regulations. They are grandfathered. So if you purchased a property before the 12th of May, you're okay. Going forward from the 12th of May, property investors can only negative gear on brand new property, not established property. The capital gains tax discount, 50%, is changing to the inflation rate from July 2027, and there's a 30% minimum tax rate on capital gains tax, which means if you had zero income, your tax would be less than 30% on average. And another huge one, discretionary trusts will be taxed at 30%, but that excludes fixed trusts and farmers, and that's from July 2028. This little bank of changes are huge. We've not seen this before.
Yeah, so give us some context on this, Roy. How long have you been working in tax and accounting?
Yeah, 45 odd years.
And in terms of this budget in particular and all these changes to capital gains tax in particular, do you remember one like it?
Since the introduction of capital gains tax in the year 2000, I don't remember anything as big as these. These are huge.
I think it's interesting, and we've got some more highlights to go through, but certainly there are some pretty sweeping changes that are going to affect investing moving forward. Have you got any sort of lines synthesising all of that? What do you think this budget has delivered?
I think that they are targeting first home buyers. They certainly want more people to purchase a home, their first home, and they want house prices to stop increasing at the rates are increasing. And these are designed to do that.
I think for what it's worth as well, and actually before I give my thoughts, let's have a look at the next round of highlights here.
So purchases prior to capital gains tax have always been taxed free, but from the 1st of July 2027, you will need to get a valuation, and any gains, capital gains from that date, will be taxed when you sell the asset. So they are no longer being tax free. Electric vehicle incentives will be continued. The $20,000 instant asset write-off for small businesses is now permanent, which is a good thing. Capital gains tax changes apply to property shares and all capital gains, including the sale of businesses. They say that NDIS is to be changed back to its original intent, and there's some $34 billion to be saved in the budget by cutting back who's entitled to NDIS. And a huge one, the loss carryback to offset against profits for 2 years. That's from July 2026. This came in during COVID. It will allow businesses to smooth over their losses with their profit years so that they can get money back that they paid tax on up to 2 years prior. I like this as well.
We touched on some of the outcomes just before in terms of making it more challenging for investing, but you've got some other outcomes as well that have come from this budget, Roy.
Well, I think investors are certainly going to shift from property to shares and other assets because property is not nearly as attractive. That means house prices will decline or have lower growth. There will be fewer rental properties, which means rents will increase. There was nothing at all on gas exports because there's a lot of talk about the beer tax raises more money in Australia than the gas tax. And the total debt's going to get just over $1 trillion, which is quite extraordinary. And our children and grandchildren and great-grandchildren will have to pay that back at some point.
So, yeah, lots to unpack out of that. I think the changes to capital gains tax are interesting, and I want to, I suppose, I'm a 35-year-old, I want to bring a 35-year-old's perspective to particularly investing. I think there's a huge change in the way that young people invest now because the avenue for the buy and hold investing of growth stocks seems to be now disadvantaged by the changes to capital gains tax. And what I do think that means is that young people, and if I have one message, and I want this message to be super clear, is that young people need to be thinking about super. Super has been, yes, there's been some effects at the very, very top end of super, but super's largely untouched in this budget from a concession perspective. There are still enormous concessions to wealth build through super if you plan and if you use the levers available for super and if you do intend to buy and hold investments for a long period of time for retirement. So a lot of people of my age think of super as something that is something that you will do in 30 years' time or in 20 years' time or think about in 20 years' time. That is absolutely the wrong mentality. And I can't be any clearer about that because the decisions you make now about super could absolutely turbocharge your retirement and completely change the way that you do retire. So if you're a 30-something listening to this, make sure you think about super. Get some advice on super because that's where the concessions are now for people who want to invest in growth stocks because that capital gains tax advantage and incentive has now been eliminated.
100% agree, Dave. And the reality is that if you combine your super balances with your partner and you have enough to buy an investment property and you can hold it for 20 or 25 years until you retire, then that property is still tax-free and it funds your retirement. And that's still an incentive for people even after this budget.
I've got one more quick takeaway as well. Is the whole thing is extremely complicated and confusing. So get some tax advice. And I don't just say that, and I know, Roy, you don't mind me saying that. Even if it's not RJ Sanderson, get some advice. Because
correct.
This whole thing is so utterly confusing and complicated that if you don't do anything about it, the apathy approach, you will lose. You'll lose in the tax system. You have to be proactive in approaching this. You can't just do nothing and expect the government to support you by doing nothing. You actually have to go and be proactive. So spend a little bit of time getting the advice from the experts, spend a little bit of money getting the advice from the experts, because particularly over a long period of time, and we're going to talk about investments in stocks and property, invest in tax, because you can save a lot of money and make some money by planning and doing that tax planning. So that's the other advice.
So interestingly, the winners out of the budget, I think, are accountants, because we'll be used more, and first home buyers, and the losers are renters.
And we're going to get to property in more detail coming up on the show. Consumer confidence, Roy. Wow, look at this. It's a 12.5% down month on month in April. It's the lowest, it's the biggest decline since the start of the COVID pandemic. And you can see that it has just absolutely plummeted.
And do we have a reason why, Dave?
Yeah, oil prices, continued inflation are the two big things. So if you can imagine, remember when petrol went to $2.50 a litre and everyone just about fell off their chair or they fell out of their car seat as they drove past the petrol station? That was a big part of it. And I think the uncertainty with war in the Middle East, but then also continued inflation, and then also an interest rate rise. So
yeah, interesting. That's a 12-month bar graph, but when you look at a longer term and you look at it over many years, you'll actually see that it's down back to where it was as at our worst points, interestingly, in 2023. So not a good time at the moment.
Not good. And yeah, it is one of those ones where we will find out next month whether it's a quick rebound or whether it's more prolonged lack of confidence. So if it's the former, okay, well then we sort of say people freaked out because there was a war that broke out that was unforecast or not forecasted. But if that doesn't bounce next month, then there is some concern, because that probably points to more long-term and structural issues.
The impact of the budget will have a play on the consumer confidence, I think.
Absolutely. We do need to mention that we are going to give some general advice, so make sure you do consume this through the lens of general advice. Yeah,
we're about to talk about some specific shares and the share market. I don't want people going out there and taking action without getting advice from a wealth manager. Reach out to us if you want to talk to somebody. First appointment is at no charge.
So the ASX, you mentioned off the top of the show, Roy, it's been a bit of a challenging year.
Yeah.
Here it is in context.
Bad month, 2.55% down. And so far for the year, it's 6.23% down. 5 years, it's 6.23% up. 5 years, it's 5.1% up. But keep in mind that on top of that growth, which is based on the value of the share market, the ASX 200, that the dividend on top of that is averaging 4.57% over the last 5 years. So if you add those together, it's just under a 10% return, including income and growth. That's the ASX 200, and I say this a lot. That's the 200 shares. That includes all 200 shares. In that 200 are some high flyers and some dogs that you don't really want to buy, and they're the worst of the worst. But they are the top 200 of Australia. If you got specific advice and you just bought 20 of, say, the top 200, your return could be considerably better. And we find that with our clients who are seeing the wealth management team, that returns are much better than the average.
We've mentioned a couple of stocks in the past, Roy, Wesfarmers and CBA. Here's their charts. How are they tracking?
I've highlighted November because between November and December was where I said these could potentially be buy shares because they had dropped so far. Wesfarmers on the left, they have continued to drop, so not such a good suggestion. But if you look at CBA, from where that dropped in the middle between November and December when we were talking about it, they have recovered quite handsomely.
A point here that I'm going to make as well is that we are yet to see the effect of capital gains tax changes on the Australian market. Now, I think that's quite an interesting space because as I said, the mentality for an investor now changes. You don't have the capital gains tax advantage and the capital gains discount. So where you might suddenly start seeing money invested in is into these dividend earners with fully franked dividends, because there's your tax advantage suddenly. That's more attractive as a tax advantage to buy fully franked dividend stocks than growth stocks that are going to miss the capital gains tax. So again, we are currently broadcasting this without any visibility of the stock market post-budget and post-budget announcement, and also noting that capital gains tax changes don't actually implement till the 1st of July 2027, should this all go through Parliament, by the way. We preface that. So, yeah, I think it's a watch this space on some of those particular stocks as well, because what it means to be an Australian stock market investment changed fundamentally overnight.
It did. There will be less property investors and money, as I've said, will shift to share market and other asset classes.
The inflation rate is concerning at the moment, Roy. You can see that it's on the way up.
4.6%, it has peaked up, which is why interest rates are going up. The target's 2 to 3%. Now, I just want you to lock into your mind 4.6% in Australia, and let's see how that compares to other parts of the world. On the left, you've got the G3 economies, and on the right, you've got East Asia. Nobody is at 4.6 or close to 5%. The highest is Indonesia, which is mid threes. Nobody else is up at that rate. So our inflation rate in Australia is not necessarily a worldwide issue. It is really an Australian issue.
Yeah, and I think when you couple that with the consumer confidence number, if you assume that people with lower consumer confidence spend less, yet we've got a rising inflation number, it really just points to the idea that this is triggered by government spending, Roy. This is not something that you and I can help by, not buying the plasma TV this year. I mean, no one's buying the TV at the moment with 82 consumer confidence. This is caused by large amounts of government spending. Overseas factors like the price of oil going up is another big one. But yeah, it's a pretty turbulent time with high uninflation and low growth, and that sort of stagnation combination. And
you comment on government spending, but the reality is I have tradies that I've done tax returns for that 2 years ago were earning around about the $100,000 mark. Not a bad income for a tradie, 100 to 110, and they are now working on big build projects around Victoria, and their income is around the 330,000 mark. So
I'm off.
That's the reality.
I'm off to get an apprenticeship, Roy.
When people talk about government spending, that's the reality of what I am seeing with, talking to clients regularly.
Very interesting. And obviously, if they're building the big build, they're not building houses, and that's impacting the housing supply. So it takes us into our housing chat as well, Roy, where you can see some interesting numbers across the capital cities.
Yeah, 9.1% combined capitals, but look at Melbourne's at 2%, the lowest on across the country. We would put that down to state government policies on one, compliance, and other costs like land tax. So, where years ago I would have 3 or 4 appointments a week to talk to me about investing in property in Victoria. I'm lucky if I have one a month at the moment, and when that one a month, they're not interested in investing in property in Victoria, they're looking interstate.
Rental growth is going up, so again, it's going to make it harder for renters at 5.7%.
And this little tick that's been occurring over the last 12 months, where it did get under 4%, it's now at 5.7 after the budget. My concern is that this is going to continue to rise, and we know that that's above the inflation rate. It's above the wage increase rate. So rents at the moment are out of control, and I can't see that changing.
Is this something that might attract investment though, Roy? If rents are going up, are there people that might think about investing in property?
They may, but although rents are going up, they have to go up because of the costs that are being incurred. The fact is there's less rental properties available, and it might attract people back to the rental market. But when you look at, on average, you can achieve around 10% on the share market with much, I'd say, long-term lower risk. Share market is volatile from day to day, but over the long term, you have safety because the market will always increase over time. I think people are more likely to go with the share market, which is seen as better at the moment.
And also the fact that rent is only one component of how you make money investing in property as well. So the other part being the capital gain, which, as you said, there's no longer the incentive on negative gearing there. So
Correct.
That might be the overwhelming factor in all of this as well. Rental vacancy rates are very low, so we've got no supply, we've got rents going up as a result.
Yes, that's right. This doesn't help. The reality is, because we have so few properties available, which are vacant, 1.5% is extraordinarily low. We need more properties. And this budget says we don't need more properties, or we don't need property investors. We want people to buy the houses, first home buyers. So don't think we're fixing the problem. Yeah,
and speaking of first home buyers, you can see that, I suppose in that sense, the government is achieving what it's setting out to do with first home buyer lending up.
So first home buyer on the left, definitely the dollars are up on the dollars that are being lent to first home buyers. But on the right, that little bar is at the 10-year average. And with the exception of Western Australia, every other state is above the 10-year average as first home buyer lending or finance. And that just proves that the policy the government are pushing, which is they want more first home buyers, is actually working.
So, Roy, it brings us to that time of the show where you get off the long run and you deliver the stunning segment that is Roy's Rage. Talk us through this one, because it's a very interesting one.
I've probably covered most of this already,
Yeah.
But the reality is the obsession with first home buyers. The government have had this for quite some time. I think it's ignoring the rental crisis, and you don't fix a rental problem by attacking those that provide housing, because landlords are selling, there's less incentives, construction costs have exploded, tradies are shifting to the big build that I mentioned a moment ago, and the record vacancies, rental vacancies are at record lows. We have a housing supply crisis, not a first home buyer crisis. And I think the government need to shift their policy.
Thank you, Roy. You certainly covered that throughout the show, but it's an interesting point. How does the government balance the need to support people into their own houses versus the housing supply shortage? So certainly a watch this space. One of the parts that we love, and to round out the show, is looking at some of the questions that have come in. Now, before we get to the first question, these are all legitimate questions.
Absolutely.
These are all questions that come across your desk during the course of your work. And we kick off with this one. I'm a coffee drinker, so I would love this to be a yes. I pick up coffee on the way to work for myself and my co-worker. Can I claim the cost of these coffees?
Unfortunately, the answer is no, Dave. You cannot. It's before you've started work, and coffee and snacks and food and whatever are not tax deductible. And just because you need it, and even if you need it for your health, even if it's for your well-being to survive your co-workers, you still can't claim that coffee as a tax deduction.
What if you were driving from one office to another office during the day and you stopped for coffee? Does that change the equation?
No, it doesn't.
Okay, we'll keep trying.
Get the boss to buy your coffee, because the boss who owns the business, they can claim the cost of coffee for staff, but you can't claim your own cost of coffee.
There you go. One that I'll never have to worry about, but I think there's plenty of AFL players who are big fans of RJ Sanderson TV. I am a football player and I've been fined this year by the AFL for an indiscretion. Can I claim the fine as a tax deduction?
Now, I can't disclose who this client is, but if you work through how many people have had an indiscretion this year, you'll come up with some options. There's not that many of them. Can I claim the fine as a tax deduction? What do you think?
No.
Correct.
And ruling on fines. So I reckon there'd be some sort of ATO ruling on people who are drivers and speed cameras and stuff.
So you're right on the presumption you just made, which is speeding fines, parking fines are definitely not tax deductible. They're cost for breaking the law. But when you are fined by the AFL or a sporting code, that fine is tax deductible. So that AFL footballer gets to claim the cost against their income as an expense.
There you go. Well, let's hope that let's hope that they get there's a small win out of a worse situation. So I'm sure that they're probably going okay anyway as it is. Let's get to the next one. Work from home travel. I work from home between 6 a.m. and 8 a.m, then travel to the office. Can I claim the kilometres to the office because I am really travelling from work to work?
Yeah, great question. And an informed question because they've raised the ATO versus Hall case. That was an ABC journalist that contended that during COVID they were claiming work from home and they were claiming travel. They appealed it. They won. Tax office were rather upset because that was going to open the door for so many people to claim working from travel from home to work. But when they appealed it and went to the High Court, the tax office now are the winners and it wasn't allowed. So the answer is no. You cannot claim the kilometres as work to work just because you're working from home in the morning.
A lot of no's here, unless you're an AFL player so far. What about this one? Changing jobs. So I was looking to change jobs, so I paid for the following: resume preparation, a police check, working from children check, short course fee related to the industry I was looking to shift to. Can I claim these costs as a tax deduction?
When you spend money on these sorts of costs and or training costs, if it's in between jobs and not related to the income you're earning on the day, they are not a tax deduction. So that, unfortunately, for this client, this is a no as well.
Well, there you go. That is everything that we had on the agenda for our first step of Year 7 of RJ Sanderson TV. Roy, do you want to put some predictions out for the next month?
I'm a little scared too. I think the share market might do reasonably well in the next month, and that's a big prediction because there's so many variables that will affect that. I think there's going to be a lot of backlash about the detail. At the moment, what we have is just media announcements in relation to the budget. Once we have the detail, I think there's going to be some big questions to be answered. That'll be interesting. I think consumer confidence will bounce back a little bit, but not by a lot. And I really hope we don't have interest rate increases, but I fear we may have because I'm not convinced that inflation with the big build and government spending is under control, as Dave predicted last year.
Some big calls there, and we will obviously have all the fallout the next time we join you on RJ Sanderson TV. Thanks very much for joining us and have a good afternoon.